Larry Gaines to the room. Now, Larry is the founder of PowerCycle Trading and has over 30 years of experience trading and investing significant capital. I'm talking significant in the oil, foreign exchange, and financial derivative markets. His passion is options trading. And since 2009, his focus has been on the development of a low risk, price cycle trading system that's very effective at consistently achieving higher profit margins with smaller capital investment. And with that, I'd like to turn things over to Larry. Larry, good morning. How are you doing today?
Hey, Raleigh. Hey, Pat. Thank you so much. Yeah, I'm doing great. Thanks for having me here. I missed your music intro, though. I always enjoy that.
Okay, I'll tell you what, I'll send you a link to the playlist.
Yeah,
By the way,
please
if
do.
anybody would like a link to the playlist, I will put it in the chat panel. But anyway, Larry, nice to have you. And folks, Pat made an allusion to this earlier. We had to postpone this session because it was planned for a couple of weeks ago, but the state of Texas had no power. And
Yeah, it
that's
was
where we
rough.
are. And that's where Larry is. So Larry, I hope you've got power, water, heat, all the good things.
I lucked out.
Outstanding. Well, it's all yours, buddy, if you want to take over the screen.
Okay.
Um,
Let me get here. Hold on a second. All right. Can everybody see and hear me okay? Let me make sure I've got the chat box open.
Absolutely. Looks good, Larry.
All right. 1 second here. All right, ready to go. Sorry about that. Okay, so what we're going to talk about here today, I mean, these markets we're talking about, is the bear market coming back? But, you know, one thing we never know for sure, right? But there is a lot of uncertainty here. We've had a fantastic move up. So you want to always have a trading edge, and you want to have more of the odds in your favor than against you. So I'm going to talk about a couple of different option strategies here today that are really great for kind of shifting the odds more in your favor by reducing the risk on any of your trades and providing some really good high return type trade setups. So that being said, the following presentation here today is purely for educational purposes. Any stocks, options, or futures mentioned does not constitute advice and should not be construed as a recommendation. Now, to me, the secret to trading profits really comes down to three things: direction, timing, and then options to manage your risk and what I call kind of opportunistic risk management. Now, when we're trading options, there's so many more advantages that you get from trading options, but you know, as you probably know, that can be a bit more complicated as well. But once you understand the benefits and the advantage that you get from options, and especially option spreads, you're never going to look back. So when you're using these kind of spreads correctly, they're going to really help you to gain defined trading risk on any of your trade setups. They're going to lower your capital at risk, which is a huge benefit, provide greater leverage, and give you an unmatched hedging advantage too, which is something that you're really going to need, you know, when we get into these markets of more uncertainty and higher volatility. Now, I've been trading options for over 30 years, and I've found that the most valuable go-to option strategies that can really help any trader more than any others is by using what we're going to talk about today is the Butterfly and the Long Condor. So I kind of call these my trading secrets. So there's they're really kind of a great go-to option strategies. I use a lot of different ones, but these are two really good go-to strategies for certain markets, and especially when we're in these kind of uncertain times. Now, the huge advantage that these strategies provide is their unique option framework that's designed to take advantage of time decay, or theta, and volatility, the two main option pricing components. So this really helps to stack the trading odds in your favor. And these can be used in any kind of market environment, but really are great when we get into more uncertain markets with higher volatility, because we can keep our risk super low and still retain a big potential return on that capital at risk. Now, because they're required to only put up a small amount of your hard-earned capital, that's the real big benefit, okay? And that's always a major win-win for your trading. Now, when we look at the butterflies and long condors, they're very dynamic, and they can be traded for a lot of different reasons, so with different goals in mind. So you can be trade a butterfly and what I say, use it for offense and defense. So basically for profit, income, or for protection and hedging. So they really provide a lot of great dynamic benefits using these two strategies. Now, they can also work no matter what the market trend is. So you could be in an uptrend or downtrend or sideways market. So they can provide you great setups, and you don't have to be perfect on that direction and timing. A lot of times when you're using these strategies, they can provide you income from stocks that are going nowhere. Eliminates that stress of having to be perfect on that direction of the overall market. Really helps to eliminate the time decay. And that's what drives me crazy. If you're an option trader, you know what I'm talking about. If you've got a long option on and the market stalls on you or whatever, you start getting that option gets eaten up by that time decay expense. So they're great for combating and neutralizing that. They also take the unsettling guesswork out of your trading because it gives you a little bit of room with these trades based on the structure. And they can be very structured for very, very low cost and low capital at risk, offering you 10 to 1 or higher returns on your risk. So of all the option spread strategies, this is the Butterfly will give you the highest return on your capital risk of any. Now, the other benefits are that they can, both the Butterflies and Long Condors, very, very flexible. So we'll go through a lot of examples here in a few minutes, so you'll see. But once you learn the fundamental setup, then you can adapt these strategies for both your goals and your market insights. So you can be kind of, more delta neutral, but I really like to use them directionally. And what this does is if you have a bullish or bearish kind of view on the markets, you can use the Butterfly or Long Condor for that trade setup. But what it does, if you're wrong, because your capital at risk is so low, you're not going to, get hurt that bad if you get the trade wrong. But the other thing you can do with these two strategies, we can make adjustments to them once you understand the fundamental structure. So, we're never going to lose typically the most at risk because we can always adjust it to even make it better. Now, let's be real. When we're looking at option trading, I mean, your option spreads are not going to offer you that unlimited profit potential, like having a long call or something on GameStop when it goes parabolic. But they're going to usually cost a lot less than buying outrights, and they're going to offer you an amazing risk to reward trade setup. So what this means to you is that the Butterflies and Long Condors can really significantly increase your probability of your winning trades, while at the same time keeping your risk low. And to me, that's really what it's all about. Now, when we look at the Butterflies and Long Condors, they're really also great for hedging. So when you mess things up, and a lot of times I know nobody here ever messes things up, but if you ever have a trade that goes against you, you're going to find out that this can be your best friend. So it's the fastest way to cover your what pronto when a position starts to move against you. And I've really literally found no other strategy or hedging strategy that comes even close. So by constructing either a Butterfly or a Long Condor around a strike that is under pressure from another core trade, let's say you had a credit spread on or a debit spread. So any of you here that are trading credit spreads, let me know, because you probably had this experience. Everything looks great, and then all of a sudden the price goes through your short strike, and then you're upside down, and it's really painful. So it can happen really fast. But once you learn how to incorporate the Butterfly hedge or a Long Condor hedge to your trading, you can really lower and neutralize that risk quickly. And here's, kind of comment from one of my members, Pam. She used to do a lot of credit spreads. She said, I wish I'd known how to do this hedging before I lost so much money doing credit spreads. And that's so true. Now, the great thing about these two strategies is that from a hedging standpoint, you can keep your original position open by just implementing a Butterfly or Long Condor hedge around that original position. So what it does, it takes advantage of the time decay component and also volatility component of option pricing, because when we do a Butterfly or Long Condor, it's got a selling component to the spread. So a lot of times, you put a trade on and it looks great. Then there's a headline or something that stalls out on momentum. And all of a sudden it's, maybe pulls back on you or stalls and you're not sure what to do. So you stop out and then all of a sudden it goes back up. So what I found with this kind of hedging, it can buy you time for that trade maybe to settle down and then return back to the, original direction. But while you're waiting, that time decay of the sell side of the component of the spread, you're getting paid to wait. And a lot of times it'll actually improve your overall trade setup that you originally had by placing this hedge on it. Now, when we look at the butterfly, they're fairly simplistic strategy. It's basically vertical spread. So in this example, this would be like a vertical debit spread, right? So you could be long a call here, short a call. So your total capital at risk would be your debit cost of the trade. But to me, as far as trading, you never want to lose your full at risk. So we could easily adjust and neutralize this trade by just selling a credit spread against it, which in this situation, we could share the same short strike or spread it out. Now, if we do it with the same short strike as the debit spread, in this example, we would bring in $200 credit. Okay. So this would be selling a call here, buying a call. Put the two together, we've just created what we call a butterfly. So a balanced butterfly. All right. Now we've reduced our risk from that $300 down to $100, and we still have a nice profit zone here. To participate if the market either stays within the zone, we can even make a bigger return on our reduced risk, or we can leg out, one way or the other to close the call side or the call credit spread side, or you can do this with puts. So those are the benefits. Now, the other thing we can do is we can spread out the short hedge and make a bigger and wider profit zone. So where we had the butterfly here with a really tight kind of window to thread here to get the maximum profit, if we spread it out, on the credit spread side, we can widen the profit zone. We have a bigger zone of profit. And this is what we call the long condor. And we can do this either with calls or puts. So if we're looking at an upside move, I would do a call condor, or downside move, put condor. So these are two really great, and they're so fast and easy to set up that we can neutralize risk quickly. And not only are you neutralizing your risk, but you're reducing the risk from this additional spread. Plus, I forgot to point out, you're also increasing your theta to a positive theta. So what, really makes the butterfly and long condor dynamic? Now, when we look at these two spreads, the most important option factor for this kind of profit generation using them, it really comes down to understanding option pricing. So as a trader, you want to understand how pricing works when we're trading options. So the big two really big components, and the big granddaddy component is time decay when we're trading options. Okay, so time decay or theta, and that really has a huge impact on the price of your option. So we'll take a look at that. But if you're trading options, the option will go to expires, and at expiration date, your options expire and they have no time left. So that's what we're taking advantage of, is that sell side of the time and selling side of the volatility, which all go to zero at expiration. Now, what theta does, it tells us how much an option price will go down over time. So it's the rate of the time decay of your option on your security. And this occurs because that time value or intrinsic value of your option goes down each and every day and accelerates as expiration draws near. So we're taking advantage of this when we're doing the butterfly or condor, because we're actually have a spread that's actually selling a sell side part of the option spread to do that. So this is how we take advantage to really make these a setup for hedging or for a low risk to high reward type return. Now let's take a look at how, kind of a simple example, how the butterfly actually works. So if you look at this example here, so this is the famous XYZ company, and it's trading at $45. So I like to look at direction. Even if you're in a kind of you think a range bound market, that's direction, right? It's kind of bouncing within a range. But let's say in this example, we think that XYZ is going to go to $43. So what I always like to do is have a target. Okay. So for any trade setup, before the trade is even put on, always have a directional target in mind for your profit take or your hedging defense if it hits the certain price target. So in this example, we're just looking for a move down to $43. And that's the other thing with the butterfly condor. We can do, small moves or big moves, or, short duration or longer duration. So a lot of variations there that we can do. But if you look here, so we're targeting 43. So this would be the body of the butterfly typically. So here I'd be buying the March 44 put, pay $2.38 or $238 for one contract. Then selling the 43 put, that's going to be the target 43, bring in $1.67 or 167, then sell that again and buy the 42 put under that. So if you break this down, you'll see, well, you've got a 44, 43 put debit spread, then you've got the 43, 42 bull put credit spread. That creates your butterfly, and the body is your two short strikes there. and also typically would be your target. So if you put the math together here, you can see that 238 on the debit for the 44 put, $1.06 for the 42, and then your credit you receive from selling the 243s times 100. So the total risk on this trade is $10. So if you do nothing else and you get it wrong, it's it costs you a cup of coffee or two at Starbucks, basically. And I'll show you an example here where this actually, you can get, these types of trades. Now your profit is just take the spread difference. So you can see it's $1 wide between the strikes. So that would be, 43, 42, $1 wide minus your cost of the trade, 10 cents or $10. So the theoretical profit, and I call it theoretical because you'll never, on a butterfly, you'll never get exactly, because you're threading that needle so close, but it's $90. Now, if you look at $90 and your risk is 10, that's a 900% return. So in this example, even if you made, $10, you made $20 on the trade, you just made 100% return. So you can see the huge benefit that you can really structure these things for low risk, but on that risk, you can have tremendous returns of actually 10 to 1 or even higher. Now let's take a look at the different butterflies so you can get an example of how they work. Now, to me also, a goal of every trader, you should be looking to select trades that's going to give you the most consistent returns over time. And I always look at risk first. The more that you've been in the business of trading, you get more aware of risk. And especially when we get in trading environments like now, which is more uncertainty. So I look at that risk first, and then I look, okay, well then on this particular trade, how much could I make on that risk? Okay. Now, so what you want to do is then look, okay, what option strategies out there? What do they provide you? How do they work? And then break it down, based on risk reward, which one would be the best for you as far as your trading goals. So, amount of capital you have to trade, the amount of time you have to trade, et cetera. Now, what you're going to see when you look and get into the butterflies and condors, they can be done with any account size. You could have $1,000 trading account or less, or you could be a big, huge hedge fund with, millions. So it's a strategy that anybody in any size account can do, and it's a really good one to add to any trading portfolio. Now, when we look at the butterfly, I kind of call it the butterfly family. There's a number of different variations, but basically you can do a long call or put butterfly. You can do what we call a broken wing, or sometimes called the skip strike butterfly with calls or puts. The ninja, I call it the ninja, which is a ratio or unbalanced butterfly, iron butterfly. And then there's the category for hedging using the butterflies. And then we've got another little subsector here, which is called the Long Condor, which is really a fantastic trade setup or strategy. And it's one of my favorites as well. So we'll look at some examples here to get you a better idea of how these work. First, we'll look at the butterfly. All right. Now, when we look at the butterfly spread, we can adjust the risk and profit based on the wingspan. So if you think of a butterfly, if you're into collecting butterflies, it's going to be probably easier to catch a butterfly with a big, fat, wide net, right? Versus a small little net. So we can then basically adjust the risk and the potential profit based on the spread width of the butterfly. So the wider, the bigger zone of profit, but a little bit more capital we put out, but the narrower, the less. So we can do a lot of really great things. And that's what makes it such a great strategy for uncertain markets. So we'll start out here and I'll show you a narrow, what I call a narrow wing butterfly. So this would be like a spread width of just $100 or $1, between strikes. And these are great strategies for the ETFs, SPY, the QQQ, the Russell IWM, any of the good ETFs that are liquid, or any of the stocks that are good liquidity, they're great. And so here's SPY. So I always like to use profit targets for the trades before ever put on. And I usually, what I use is Fibonacci and unusual option activity and some other things. But in this example, SPY was looking like it was going to break higher. So you can see this 382 retracement where my pointer is. So it was trading around 267 right in here. And we had a target to that 618 retracement right around 273, 274. There was a lot of option activity there. So it gave a perfect target. So this was doing a butterfly to this target of around 273 and a very low risk trade setup. So if you look at the trade setup, We were targeting that 273, and the trade was going then long the 272 call, short the 273, and then short the 273, long the 274. So $1 between the spreads. So that's $100 spread width minus the cost of the trade, which was 10 cents or $10. So your potential profit, if it nailed it perfectly at expiration at 273, would be $90 on that risk of 10. That's a 900% return. So in other words, you're risking $1 to make 9. Now this 2 days later was actually up $70. And on $70 though, that's a 700% return. So 2 days later, this is making 700%. So that's the really beauty of the trade, is that risk reward is fantastic. So here it was 2 days later on the day of expiration on the 16th, and it was trading almost perfect at 273.08. So you see that little black area is what's still left of time that's in that option spread and volatility. But this one was really stripping it out. So it went from 10 cents to 80 cents or $80. And that's your $70 profit per contract on $10 risk. And that's a 700% return. All right. So that's one great example of how you can incorporate the butterfly. Now, this next one will be using the other thing that we've been doing a lot of PowerCycle trading. When we do a short trade, we typically look to have the short trade in a kind of position where we can either do it as a butterfly or convert it to a butterfly to reduce our risk, because it's been really hard to short this market, right? And a lot of times, if you're not, really focused in on it, it'll drop down if you short, but then, before you know it, it snapped right back up. So what we've been doing is, when we do shorts, we'll maybe start out with a put spread or something like that, but always end up with maybe the butterfly, or start it with the butterfly to keep our risk super low. So here's an example of one that we set up back end of January. And we had I use a trading model that I designed here based on momentum. You see my pointer, but we had a retracement bounce. I like to look at, when we have a big sell-off, if you miss the first big plunge, typically you'll always get a retracement to a moving average. So we call this like a retracement bounce. So when it gets to that retracement area where you think that could stall, then you look at your lower time frame momentum, and if it stalls, that's where you can then do a reshort. So that's what we did on this trade. And we did this then using a butterfly to keep our risk low in case we were wrong. So with this trade, we had a price target based on Fibonacci to 270. And at the time the trade was set up, it was trading at 275.55. So bought the 274 put, sold the 270. Okay, then sold the 270, bought the 266. So $4 wide is the spread, so $400. But look at the risk of this trade, it's $41. So if you got it totally wrong, if you win the trade and it went straight back up and you couldn't do any adjustment, you lose $41. So, that's bearable. Now, but the big thing though, if you nailed it perfect at expiration, you can make 359, which would be 876% return. But we're not looking to make that. We're looking just to have a low risk trade where we can participate in a downside move, and we're going to be happy. Here we made $35, and then we made a little bit more a day later, but that's still a great return, 85%. So it was trading down here. This was set up on a Friday, okay? And so the first profit target was the same day, Friday. So that was $35 per spread on the butterfly on that risk of 41. So one day trade 85%. But the big part of it is that, if you did get it wrong, your risk was 41. Now with the SPY, you've got different expiration series. So we did this one for expiration on the next Monday. And so that gave us even more potential for one more day, basically. And so then on Monday, it was actually trading a little higher at 272.73. But we were able to, squeeze out some more profit on it. So at that point in time, it went from 41. Now it's trading at 94. So there's your $53. So 53 per spread on that risk of 41, you've got 129% return. Now that's on one contract. So, if you did 10 contracts, you can kind of figure out the math. So, but the big thing I like to look at again is that risk first, and that risk first of 41 is a really, enticing there when you're trying to do a short. It's been hard to do. Now here's another good example of how they can be beneficial using a butterfly. So this is a wide wing butterfly on Amazon. And Amazon, you know, if you're just to buy the shares equivalent to one option contract, you buy 100 shares. So this is how you could play Amazon, Teslas, things that have high price shares to participate, but at a very much lower capital at risk. So we were looking for a breakout trade to the upside, and Amazon was trading at 3,150. And so based on our Fibonacci levels, we had a target here to 32.20 in here. So can't afford to buy 100 shares of Tesla. That would be, you know, you'd have to put out $315,000 basically. But let's say you did buy 100 shares to participate in an upside move, and it did hit your target at 3,200. Well, you would make $50 a share, but your return is only a 2.33% on that capital at risk. But your risk is, you know, would be equivalent to $315,000. That's a lot of risk. So the other way you can do this and participate in big stocks like this is doing it with a butterfly. So here we targeted 32.20, the target that we had, but we did it with a butterfly spread that's $30 wide, or 3,000. So we bought the 31.90 call, sold the 32.20, and then sold the 32.20, 32.50. All right, so you can see that's $30 or $3,000. So if you did one spread, your spread width is $3,000. Now the cost of this trade to put it on was a debit cost of $388, right? Versus a cost of $315,000. So you get the point there, right? So 388, you can see the debit cost there. So that's the max risk without, if you did everything fell apart on you, you'd lose 388, but typically we can also adjust that down. But here's the big thing is that if you nailed it, if you got close to that 32.20, you could theoretically make $2,612, which would be over 600% return versus a 2% return. So let's take a look here. So this went up and had a nice move up, and actually went up to that 3,200 and above, but it provided a great opportunity to trade this stock versus the shares. And so you can see where it was right here going out on the 27th and set up on the 25th. And 2 days later, it was trading right here with over $1,000 profit. Now that went, then you can see my pointer down here below, it went from 388. And at that point in time, it was trading at $14.26. All right, so there's your profit of 1,038 on one option spread, or 267% return on your risk of 388. So to me, a lot better than trying to play something that's, you know, you'd have to fork out a huge amount of capital. And here's another really good one on Amazon. So these are, you'll see a few examples here because Amazon can provide some great trades, but here's another benefit. Not only can you trade a high price stock, but you'll see here by using the butterfly, the advantage of time decay into expiration can really accelerate, and in this example, and increase your return in 1 day by 4 times. All right, so here, let's take a look. So here was Amazon again, and it was trading about 1,782. So coming down into this big support area there, that was a 200-day moving average. And so we were setting a target for 1830 right in here, this area. There'd been a lot of resistance and it failed there. So that was the target. So that was the basis of the trade. So target trade to 1830. So it was trading at 1782. Again, think if you bought 100 shares of Amazon and you'd pay 178,000 basically, right? And then you hit your target of 1830. So you make $48 a share. So 2.69% return, you know, but look at your risk. Now here you can do the same trade, but your risk here on this trade was $80. All right. So bought the 820 call, sold the 830. That's the target. Sold the 830, bought the 840. So $1,000 wide spread, $80 risk, potential return 920. That's over 1,000%. Okay. So here's the other advantage. So here it was on the day of expiration in the morning. So this was about 9:30, 10 o'clock a.m. So Amazon had gone from, it was currently trading in the morning at right here at 1836. So it overshot our target. But at that point in time, you can see it's going almost outside of the butterfly here. But at that point in time, we were able to get $150 per spread profit. All right. Now 150 on your risk of 80, that's still a fantastic return. That's 187% return. So you can see down here went from 80 cents to 230. All right. Now That's in the morning. This is about 9:30, 10. But look what happened about 4 hours later. This thing was up 4 times more. All right, here it was in the afternoon, and it was almost currently, very close to the same price, but it was trading right here at 18.32. But look at the difference here. It went from 80 cents here. Now it's at 695 or $695. So that's your $614. So that's it went up 4 times what it was in the morning and 4 times on your return. So, and that's because of the time decay component starting to go to zero at expiration. So this is on day of expiration. And you can see that little black area that's very, very small. There's not much. That's showing you that what's left of profit is time and volatility and very little left. You can see here, see all that in the morning, how much time was left in there. That's what we can look at with the analytics. So that was a huge amount of profit still sitting in there to be stripped out. And it got stripped out right as it was going into the closing part of the day for this expiration. So from here, a 187% return or 150 per spread here, the same day to over 600 and over 700% return on that because of that time decay component. Now here's an example of the Long Condor spread. And I love this one because it gives you a wider profit zone. So this is kind of a major go-to strategy we use a lot. And this was on CRM. Now I've got alert service, and these are alert trades that were sent out, but at CRM, we had a breakout here and there was a lot of overhead resistance. So I like to do condors when we have the overhead resistance so we can keep it low. But this is basically a long haul condor. So the entry was on the 26th. It was trading at 226. But look here, again, your risk, $59. We structure this for a risk of just $59 per spread. Now, it went from $59, and this was then up to, on the 26th, we set it up, and then on the 3rd, it was now from 59, now it was trading $166. And so that was a profit of up $106 or $107 per spread. All right, so $107 per spread profit here on your risk of 59, that's 181% return. So didn't get quite the max, but if it had gone out between these two short strikes at expiration, if you held it to expiration, it went out here, that would have been $191 or over 300% return. So another really good one. And see here, this is a theta, positive theta, $12. So that's another big positive. So here's what it looks like. So maximum risk 59, potential maximum profit 191, but you've got a big profit zone. It's got a positive theta type trade setup. Now here's another one. Now this is what I call kind of hedging or opportunistic hedging. This was a short trade that we set up on, again, SPY, doing a put debit spread targeting down here to this 270 area. But again, every time you do a short, it tends to bounce back up. So what we would do is you do your put spread first, you hit down your target, you take profit, and then you adjust it to either a butterfly or a condor if you can recover your risk. And in this one, we turned it into a free trade. So started out with the 273 put, 270 put debit spread for $65, nice positive risk return, low risk 65. Now, if we nailed it and it closed below, the 270 expiration, you make 235, good return to over 300%. But, the market snapped back so fast, it's hard to do that. So when it hit down to our target, you take profit on part of the trade right away. So that was $98 per spread, still a good return, 150. But then the next thing you do, can you convert this to adjust the trade cost down, maybe to zero or even a credit? And that's what we were able to do. So when it hit down to the trading target, we had 270. Part of the trade, what we did was sold a bull put credit spread, sold a 268.65 put, brought in a credit of 65. So that offsets that debit cost of 65. Okay, 65 debit, 65 credit. So now we have a free trade, zero risk, and sit back. Now, if it goes out at expiration between your short strikes of the spread here, you'd make 300, but it wasn't going to do that, but it was close. So it was going out right here at 271 basically, and it was up $164 per spread on zero risk. So beautiful trade there. So trade one made 98 or 150, but trade two, by just doing that simple adjustment, made twice as much, 164, but on a zero risk trade. So that's the thing that I like about these two strategies. And they're, like I said, very, very important to what we do as far as go-to strategies. So if you'd like to learn more to master these, what I call high reward, low risk, there are two things you can do. First, hopefully you got a lot of good ideas here today, or if you'd like to really master these in a lot quicker fashion, I've got a really fantastic course that I just completed. We did this, just finished this. This was in January, actually, but now we've got it on demand as a recorded course. So if you'd like to take advantage of this, I've got a fantastic offer. So this is a Butterfly Long Condor Masters course, and you should. I think this is the link. It's $197, but you're going to get a lot of great benefits here as well. So let me go through everything here and ask questions if you like. So here's the package here. First, you'll get the recorded on-demand course of the Butterflies Long Condor. So this is just recently done. It's 7 hours over with the additional course and the Q&As that we did. So you get all these are broken down in modules, like a chapter of a book, 30 minutes or less. And then you'll get the PowerPoint. My courses are very detailed, so you get the full PowerPoint of the course as well. But not only will you get this, but you're going to also get my new Fibonacci target mapping course. This is one I did in December. So and these prices are, if you went to my website, PowerCycle Trading, these are the cost on the site. But this is going to be a bonus for you as well. And that's a really great course if you're needing help on targets for, where's the market going to go to as far as a price target, up or down. This is a 3-hour course on how to do that. And then you're also going to get my brand new Options for Beginners course that just finishing up on that. So really good beginner's option course. So you can add that to your trading library. Now, once you buy this package here, these are yours forever. All these courses. So you can get a login to your vault, and it's on the cloud. So you can always access these courses. Hopefully you'll stay on as a member, but if you don't, you can always still access your courses. And if you lose your email login, just let us know. We'll give you a new one. And then I'm going to give you my other beginner's option program. So you're going to get great value for option trading in general here. Now I'll send you we'll do a follow-up Q&A probably in a week or 2 weeks. So I'll send you a link to that. So you can go through the course, come in and ask questions, and this will also be recorded. Now, you'll also get my option trading tutorial. So basically another course on the option Greeks and probabilities, standard deviation. I'm going to give you my option strategy manifesto guide, my power tool guide, which is the option Greeks, and a trial membership to my PowerCycle Trading Club for 30 days. Now, you can start this whenever you want. So if you do this today, you buy this course today, you don't have to start the club tomorrow. If you want, send us an email. We can start it a week, 2 weeks, whenever you'd like to do that. So let us know that. And then let's go through these bonuses. So first off, you're going to get the Options Masters course. So this is focused on the Butterflies Condors, 7+ hour course, 437-page trading manual with a library of a lot of different option trades, Butterflies Condors, so you can go back and look at. And so it goes through how to trade the butterflies for income and hedging, etc. So part 1 is a really thorough course. We go through the Greeks that are vital and important for the butterfly condor, how theta, impacts these two spreads, how volatility impacts it. So we're taking advantage of theta and volatility, how option pricing works. So for any of your option trading, this is really helpful to understand pricing of the options. So we go through that in great detail so you understand that. And then go through the price target mapping, which is very important for any of your trades, and how that is done using Fibonacci and standard deviation for selecting probability targets. And then part 2, we go into the core basics. Now, most people it kind of demystifies what a butterfly condor is and what makes them work, and then how this foundation works, because they're basically combining vertical spreads. And then get into how, why, and when to use the different variations of a butterfly. So go through with trade examples of when would you use just a long call or put butterfly, or when would you use the wide wing versus a narrow, or a broken wing butterfly, or the ratio butterfly, or how and why would you use what is called a broken wing ratio butterfly, the iron butterfly, vacation butterfly, and long condor. So the course goes through, I take you through each one of these variations with trade examples of how, why, and when that you would use those. Now, also go through, when do you set these up? Should you do it 1 day out, 2 weeks, 2 months, 3 months? So take you through the optimum best timing for these, what stocks and ETFs to use, or index options like SPX. How do you get those trades where you get 10 to 1 or higher? So, I'll show you what to look for there in the course. And then how do you profit, or how do you take advantage of what we call volatility collapse and that theta decay with these two spreads? And then another part of the course, kind of a little bit of a chapter to itself, is how to trade what we call pinning, okay, monthly option expiration, which, obviously is 12 times a year. So it's really fun once you understand what pinning is and how to take advantage of it. So if there's a certain strike on a monthly option where you think that it could settle, what we'll do is we can set up an option trade, typically using a butterfly, to take advantage of that settlement price, or what we call pinning. And so with this part of the course, we'll use price target mapping to establish that strike price for a pin, and option activity to do that. So take you through how that's done. And then we get into the Long Condor section of the course. And this is just dedicated to this spread, which is a great kind of a variance of the butterfly. And then part 3, a big part of the course, is hedging. So I take you through this part, progressions of hedging. We go through all the different progressions from, if you're long a stock, you can hedge it like this. If you're long a call, et cetera. So the progressions of hedging, and then get into the final progression, which is hedging using the butterfly or Long Condor to hedge a core position or to hedge vertical spreads. So, if you've been getting eaten alive with the credit spreads, this course will teach you how to hedge a vertical credit spread. And then execution trade management. You got a resource library about what is assignment risk, expiration, auto exercise, how to avoid that, what it is, and then a trading library. So I always like to give you a lot of different past trades that you can look at to get examples of how they work. So just a little feedback. I'm close out of time, but you're going to get a fantastic benefits from this course, and I've had a lot of happy campers that have done this. So use that link there. I think if that's the correct link. The one you're seeing there is not right. So here are your trade bonuses again. You'll get the full price target mapping course along with the full Fibonacci option course on butterflies. So this is a course I did in December. So it takes you through what I call price target mapping using Fibonacci, moving averages, price action, standard deviation, unusual option activity, all of that. And then you're going to get my option trading for beginners, brand new course that I've just completed on that for option beginners. You'll get my option beginners home study package, another option course for beginners. And then we'll do a follow-up live Q&A, which will be recorded. You'll get my option trading tutorial, 60-page option guide with videos on the Greeks, option delta probability, 15 option strategy guide. If you're, what's the back ratio spread, long straddle, strangle. So just another really good benefit guide here, and your options Greeks. So you can print this out, put it on your desk, and a trial membership, 30-day membership to my club. I have a virtual trading room open each morning. So 9:30 to 10:30 back for the close. So you get access to this every day during the week. My video newsletter after the close, Q&As every Tuesday, live and recorded, discounts, 60% off on all courses and software. So a lot of great stuff. And, this will really get you up the learning curve here with this one package, because you get so much out of it for a very low value, a great value of everything here, but at a cost that, you should be able to absorb and make back really fast. So I hope that covers things for this, to give it a good summary of, how fantastic these two strategies are. And I think I'm almost out of time, but I appreciate having the time here to spend a little time here today with everybody.
Hey, Larry, that's terrific. What a great presentation. And we have actually about 10 more minutes. So
okay.
We have time for some questions. And,
Yeah.
Larry, once again, comprehensive presentation. The one question that came up several times is, Larry, if I'm a total newbie to options, I don't know options from a hole in the ground. This seems kind of complex. Is the program, do I need to have knowledge or skills in options, or can you work with a newbie and work up to this? Help me understand that.
Yeah, great question. So, excuse me. So one thing I try to do here is present you a package that's going to get you everything you need to know as a newbie or more advanced trader. So with this and again, remember, this is yours forever. So if you were to sign up today, not only will you get this Butterfly Condor course, but when I go through a course, it's step by step. It's very, very methodical and detailed when I go and do a course like this. So I start out with the kind of the basics of the, the options components that you need to understand. So
Okay.
even as a new option trader, it's going to introduce you to what you need to know for any of your option trading. Now, then the next thing I like to do is I'm going to give you this beginner's option course and option program here. So this is just for anybody that's just starting out. So to tell you, okay, what is a put? What is a call? What is expiration? What are some simple strategies? Okay, so that's yours. But the whole thing here is yours forever. And so what you'll have access to is not only this fantastic course on the Butterfly Long Condor, which can seem more advanced and obviously is than just going out and buying a call or a put. But once you then dive into it, if you're dedicated to wanting to learn to be a successful trader, these are things that will really help you be successful, and also successful with a lot lower risk in the market that you're trading. All right. So if you start thinking about looking at your risk first and then looking at your returns kind of second, you're going to do a lot better. So focus on risk. And that's what I do. And these are strategies that focus on that risk side
Sure.
and then provide you the potential for huge, great returns on that lowered risk. So my answer is that yes, it's anybody from a beginner to more advanced. It's appropriate and a good starting point for you.
So that's excellent, Larry. So in other words, everything that you need is going to be packaged up in this course.
Yeah,
So if you don't
everything.
know
And then,
about options or theta and data, the Greeks and all that stuff,
yeah,
you lead people through that, establish a baseline. And I think, as you said, butterflies and long cord, they're more complex, but you introduced a hedging strategy, which is something that you apply on top of decisions that you've already made. So it's a little bit more advanced. But once you understand how options work, you immediately see the value in the strategies you put together.
yeah, that's right. So, if you're starting out in trading, you always, start out paper trading too, but what you're going to do, and over my long course of trading, I've found when I finally, the lights came on when I started trading options, it just changed the whole dynamics of trading. Because when you first start out trading, options get, sound all spooky to everything and complex, but they're not really. It's just a price. It's just a price on the underlying security of the option to that. But
Okay.
what you're going to find is that by using options in your trading, again, you go back to, you're going to you're lowering your risk. And that's where a lot of people, the misconception, people think options are a lot riskier, but it's actually the opposite. So because options were designed and created for hedging first, and then they became this big, huge industry of speculation and everything. But when you're just going long calls or long puts, those are super speculative. And that's where you either make a lot of money or people are just going to get, rolled over and
Get
end up
crushed.
losing it
Yeah.
all. But if you focus in on looking then to the next level of your trading, which is using option spreads, not outright options, then you're going to manage your risk. Okay. And that's what's really it's going to come down to. So one thing with trading, I think over the last couple of years, it's been an easier game. Everybody just buys, goes long, go long, go long, go long. But what then eventually at some point we'll get this market cycle where people have never seen before, where you have more fluctuations and price movements up and down. And the old type of trading of just, I'm just going to go long calls or whatever, is not going to work. And you're going to end up probably giving a lot of it back, because any of us that have been around since 2000 or 2008, remember that horrible experience of a market crash, which, we'll probably not get that again, but you never know. But that is embedded in your memory bank. So everything since then, I've always looked at that risk in such a greater detail than the actual profit. Now the profit's going to come. And if you do these option spreads, the profits will come because they're structured and designed to give you profit, but your profit's going to be on lower risk. And
Sure.
so to me, it's just, there's nothing else that compares.
No, that's excellent. And just kind of a follow on to that, Larry. So now somebody's got your course and it's comprehensive. Do you have any thoughts or recommendations on what kind of platform or brokerage to consider? I know that's a tricky question, but generally speaking, do you have any advice for people there?
Yeah, sure. I mean, excuse me. For one thing, though, to mention too. So the other thing with this package, you'll see you'll get a trial membership to my trading club. Now, if you stay on, it's 97 a month, or you can do an annual membership for 48. But this is a big, also big benefit for anybody starting out or any advanced trader to come into the trading room each day. And if you have any questions on any kind of trade, not only options but just directional trades, I'm there to help you. So this is a big kind of a big, point of a benefit as far as this package as well. And then I do have an alert service that I didn't even talk about here today, which is another great value package where I have 4 different alert services if you need additional help. But when you're looking at your option platforms, yeah, they're, Thinkorswim is great. TradeStation is fantastic. Tasty Trade is good. You've got, Schwab, Street Smart Edge, all these interactive brokers, they're all pretty good. All right. And it just then depends on your platform. Now, I really like the Thinkorswim platform, and all my indicators and trading models that I've designed. I first do it with Thinkorswim, and then I take that same indicators that I designed, and then the next one I transfer it into is TradeStation, and then Ninja Trader, which is good, really good for futures, and then eSignal. And now our good friend Rob Hoffman over at Wealth Charts, we're getting all these indicators on Wealth Charts, but they're not a brokerage platform. But so, basically what you can do, a lot of my members and do is that they'll maybe open up an account at Thinkorswim, and you can get access to the platform. Basically, it's a free platform once you register and sign up for TD Ameritrade. And then they'll use the Thinkorswim platform, but they may have their money at Fidelity, or they might have their money at Vanguard, but then they'll place the trade at, maybe they'll place it at Schwab or
Okay.
Fidelity, but the platform they're using is Thinkorswim. But TradeStation's great, Tasty Trade, they're all pretty good interactive brokers. But I love the Thinkorswim platform quite a bit.
Okay. Well, I'll tell you what, I think once again, appreciate that. And as you say, you're not really locked into any one. Those are very, very widely available platforms. And as you indicated, your indicators are available across a number of those as well.
That's right.
Getting a little bit more specific, there was a question there right at the beginning. You were talking about how important it was to establish a directional price target.
Right.
And that was kind of your starting point there. Well, how do you establish that? What kind of things do you look at determining what is that directional price target? You
Yeah,
look
they're
at some
basically,
fundamentals for that?
no, I never look at fundamentals. I'm not that smart. With all I look at, I've been doing this a long time, but for me, there's a lot of noise in the market. So here's a good concept. So fundamentals are great, right? They're great for identifying maybe a great company, the fundamentals of the company. But when we trade, it really comes down to price, right? Who cares
Mhm.
about the fundamentals? So if you we would always joke that if it moves, you can trade it, right? If you have it could be widgets, it could be paper clips, whatever. If there's a price, you can trade it. So it comes down, if you're going to make money in trading or investing, it's the price. So the fundamentals go out the window. So you can see when we have a meltdown like we've had, which isn't even a huge meltdown, it doesn't matter. The NASDAQ 100 goes down, it drags everything down with it. Even the stock companies that you think are fantastic, Microsoft, great fundamentals, but they all go down. So it really comes down to price. So with this course here, this is a price target mapping course. So I use Fibonacci. I use moving averages, or what I refer to as automated trend lines. I use price action, support resistance levels, standard deviation for forecast. And this is where we use options, because even if you don't trade options, if you understand the option platform, you can get great price levels based on using standard deviation with the platform if you want to do this. And then option activity. If you see a whole lot of unusual activity at certain strike prices or open interest areas, those also identify potential price targets. So basically it's like, what is this, 5 different things I look at. And then before I ever do any trade on one security, I look at those various levels based on that mapping process. And that really then helps me to establish good areas to trade to. So if you're looking here, we did a put spread here this morning in our trading room, and we're targeting, here's QQQ. So if you look here, see this level here, this is coming in about 308.
Right.
Now this is a measured move using Fibonacci. So I like Fibonacci for price targets. But the other thing I like to look at is different areas of price action. You see the price action, see all that action there?
Yep.
Okay, so that's like 310. All right, so 310, 308. So these are kind of aligning together. And then when you look at the option chain, your option series for this week, next week, the week after, you'll see a whole lot of option activity also at 310. All right, so you can see then today, this thing had made an approach down here towards this area of 310. And you can also see here's the low from the 26 is 311. So this is kind of the range we're looking at, close to maybe 310. And this then provides you a good target if you want to do a butterfly, because we could target 310 as our target and we can make it a wide butterfly, $5 wide or so. We still have a good profit zone for that potential butterfly to work out. I'll try to find my option chart here. I'll show you if I can pull it up. So
this is great, Larry. This is a super example here.
So we had this today. We did we started out with a put debit spread, and then if you wanted to, we adjusted it and converted it to a put condor. Okay, so here's kind of what it looks like. And so it knocked down the risk and increased the positive theta. So the trade, we did this in the trade room this morning, started with a put debit spread here. We did the 5 March, 315, 310. It was about $1.40, $1.45. Now this went up to over $2, so you could have taken profit. But then the other thing, when it flushed down here, like here, then we were going to look to either set it up, create a butterfly, or this is a put condor by selling the 308, 303 $5 wide bull put credit spread. At that point in time, it was over $1, so 98 cents there. So look what just happened on this trade. We had a risk here originally of $143. And look at the theta. We have a negative theta of $6, $7. Now, as it flushed down here, you take profit if you have some to take, or you can adjust this quickly by either doing a butterfly or condor. So we did the condor, sold the 308, 303, brought in $98. All right. So what happens here? Our risk just dropped from 143 to $45, right? But also look at the theta. We have a positive theta. So if this was to sit here the rest of the week into Friday's expiration, this trade will still be up $80 just from this positive theta. All right. So that's the exciting thing about options. Yeah. There are just so many different ways that you can do it. So don't just go long calls, long puts, learn option spreads, and you're going to end up over the long run. Spend some time studying it. And that's what I'm here for, is to help you do that, because I enjoy teaching people, and it's very rewarding. So I appreciate the opportunity to be here today, and hopefully you guys and gals see some things that you can incorporate down the road.
Well, that's great, Larry. Thank you so much for your time today, because I know you're busy, and folks, you just got a real look over Larry's shoulders. These are the kind of things that he does on a daily basis in his live trading room. So not only does he provide you the trading tools, but you actually get to see and listen in on the kind of decisions that are being made, and he explains why he's doing that so that you can incorporate these yourself. Larry, thank you once again for your time. I know you're busy. Anytime we can grab you for an hour of education is just fantastic for us. Take care, buddy. You have a
Thanks,
great
Raleigh.
day.
Thanks, Pat. And send me that music link. Man, Raleigh is, if you haven't seen Raleigh, he's a great drummer and a really cool band that he's with. If he's still doing that, they're good.
Really. Larry, I have threatened Raleigh that instead of this music deck that he does in the morning, we're just going to have his band play.
I know. I mean, I'm not kidding you. They are a really good band. Really good.
Well,
So
thank you, Larry. We're coming up on a year since our last performance
I
for
know,
pandemic reasons,
yeah,
but that doesn't mean we haven't been creating music in the background. But I really do appreciate that. And yes, everybody, I do enjoy trading. I do enjoy moderating these sessions. I do enjoy working with people like Larry and the other speakers that we've got here. They're just unbelievable educators. And then I also enjoy making music. So, Larry, you have a great day, my friend.
thank you very much. Bye.
So folks, once trading, and he's just, I mean, I think you can understand, obviously, from listening to him that he is a high quality educator that goes out of his way to share his knowledge, his extreme knowledge on how to trade options. And his course, which is the Options, Profits, and Hedging course, all new Butterfly, Long Condor options, bonus courses for options on beginners, the Trading Club trial membership. Too many bonuses to mention. I think the price for that was $197. You can go to westmarktrading.com/gains, and that will take you directly to the link that he shared on the screen so that we don't confuse you. But it was terrific to have Larry here. And here we are, Pat. It's at the top of the hour. It's